I will have this on all your favorite podcast platforms. I'm hoping to be finally caught up in a month from all the prior conversations. Any kind of help in spreading the word on the podcast, Lead Lag Live, is much appreciated. My name is Michael Guyad, publisher of the Lead Lag Report. Joining me for the hour is Mr. Blonde himself, MrBlonde_macro. So, Mr. Blonde, I know you want to stay anonymous, but to the extent that you're comfortable, just talk a little bit about who you are, how'd you get involved in markets, why you're qualified, I guess, to talk from a macro perspective around the current state of things, and do blondes have more fun?
Great. Well, thanks, Michael, for having me. I appreciate it. Although I'm a little disappointed. I thought maybe it would be Stuck in the Middle as your intro.
I know,
music.
right. I goofed on that. You're 100% right.
Just giving you a hard time. No, listen, look, there's some, other podcasts and interviews with me out there. So I won't spend too much time on the career path, but just, really quickly on some of the things that I've done to date. I spent some time at a, bulge bracket investment strategy, equity investment strategy position at the same bulge bracket firm. Spent time on the derivatives, trading desk. Is a combination, of trading with clients of the bank, as well as, interacting with sort of research, desk strategists, if you want to call it that. From there, left and went to a more traditional buy-side seat, long-short equity focused hedge fund, of critical size, let's call it sort of north of 5 billion. Spent the bulk of my career there, and then left that seat looking for a new challenge and sort of joined a very large multi-asset, kind of more long-only type institution where my objective was to try to help them better understand how to read, interpret, and engage in equity markets. And left that seat in late 2020, frankly, to just take some time off and enjoy time with the family. And you don't get that opportunity too often in your career. And so while I was taking that time off, decided to stay engaged with markets and share my thoughts and framework and thought process and see where that path ultimately leads.
Okay, so path is a good word to start the nation with, because I always make it a point that path matters more than prediction. And in the macro world, a lot of people obviously have their reasons for why they think things will play out the way that they do, which is really more, I would argue, about, from my perspective, more about the endpoint in terms of an analysis, the conclusion, as opposed to how you get there. And you mentioned that you have experience on the prop side, the desk strategist side. Talk about, from your experience, how challenging it is to marry a macro view to the sequence within the macro view, because I think this is what a lot of FinTwit really doesn't understand as far as the nuances of how to actually trade.
Yeah, look, I mean, I'll use my sort of direct experience. I mean, moving from a traditional sort of research seat to a seat where you're on a trading desk where live, large, significant positions are taken, you learn pretty quickly that what works in theory doesn't always work in practice. And it's not to say that the theory is wrong. I think in many cases, the theory could be sound and thoughtful, but the time frame with which that theory works is inconsistent with the time frame that you have to manage and evaluate risk, right? So, something that, will work over the course of 3 years, that's great. But if in the next 3 months it goes completely the opposite direction for whatever reason, that's a pretty difficult position for anybody who's running active money to deal with, unless you're in this really lucky, fortunate position of having sort of like locked up mark to market insensitive capital, and nobody cares about what happens in a 3 to 6 month time period in the context of your view. So I fully agree with you. I mean, I think path is often more important than destination. It's not to say that the destination isn't important, but the path that you take to get there, I think more often than not will sort of dictate whether you get there or not. And I think so. That's a lot of my framework, and we can get into this, but it's sort of why I spend more time and focus on things that I would consider to be part of the cyclical time horizon, and less focus on sort of secular themes or views. It's not to say that I might not have that opinion. I think that I guess I would say that my 5-year view is a series of 6 to 12 month views as opposed to a static 5-year opinion.
No, and that's an important point, right? It's like, the long term is nothing more than a rolling series of short terms, right? So you need to be aware of the two. But that point about having capital locked up, I think is worth paying attention to, because to your point, if you have a gate, if you have something that prevents people from getting out of a strategy, then even if in the here and now the strategy is not quote unquote working, you have time for the theory to play out in the reality, right? And it's interesting because I think the ETF landscape in some ways has actually made innovation harder, in the sense that because it's real time, because people can get in and out very quickly, when you're in a dislocation, the patience is not there for the theory to play out.
No, I mean, listen. I mean, I think, and this is a little bit of experience in working with allocators or investors of capital. I mean, it's a little bit. People talk about the idea of like, oh, well, hedge funds have too much turnover, or they're too short term in their thinking, and other criticisms. I would say that the reality, I think, is oftentimes the allocators or the investors in such funds are the ones who actually are driving a lot of that short-term thinking, because I can tell you when you have a bad month or something doesn't go right, like they're all knocking on your door and saying, well, I don't know, maybe this isn't the right strategy for us, right? They're starting to question the strategy. It's not true of everybody, but it just is. I think a lot of that pressure comes from the outside and makes it, certainly makes it harder on the part of the active manager. And to your point, yeah, I mean, the ETF and the daily liquidity profile of the product, which is, as I think overall is a good thing, but it does put a lot of the emphasis on whoever the investor is or the buyer understanding the range of outcomes in a given product. And I would venture to guess that many people don't spend time thinking about that, and it's a little bit more of just a performance chasing exercise.
No, I think that's spot on. And you probably have seen some of these studies too, that if you were to look at the investor returns in an S&P linked mutual fund versus an S&P linked ETF, the investor returns tend to be higher with a mutual fund than an ETF, because the mutual fund's pricing daily, right? And let alone if there's a redemption fees attached to selling. It is this interesting dynamic where people increasingly want liquidity and transparency, but the temptation to act off of it, that liquidity and transparency, I think, is to the detriment of investors because of their own behavior.
Yeah, well, it's a combination of both the FOMO behavior, but also like loss aversion theory is a real thing and studied and proven. So the combination of those things, I mean, they're both kind of a version of loss of aversion theory. One is the feeling that you're losing relative to somebody else or something else. That just attacks the weakest part of the human brain.
Okay, now let's talk about your framework in the context of taking risk. But before doing that, let's first define how you think about risk, because traditional finance would say that risk is volatility. Volatility to me was never about risk; it's always about doubt. I mean, the real risk is risk of ruin. But I'm curious how you frame from a macro perspective what risk ultimately is.
Yeah, so I agree with you. I mean, I think there's different shades of risk. So I mean, volatility is one shade of risk. I mean, I think that I would say when we talk about volatility, I would say I probably care more about like fundamental volatility than I care about price volatility. Now, they may or may not be mutually exclusive, or sometimes they can be consistent, sometimes they can be inconsistent. But when I think of within equity markets, like variance of cash flows is a source of volatility. Balance sheet leverage is a source of risk. I'm sorry, variance of cash flow is a source of risk. Balance sheet leverage is a source of risk. And naturally, you would expect that price volatility, would, be an outcome of such things. I agree with you. I mean, I think that, the risk of ruin is probably the most important, right? So, and this is sort of what makes equity markets a little bit different than some other markets. For instance, I'll make a comparison to credit that I think often, comes up. In the credit markets, if you have a credit that falls to 60 cents on the dollar, as long as more bad things don't happen, then that issue basically pulls to par. And if you're smart and thoughtful about it, you can make a lot of money that way. In the equity market, a stock that falls 40%, there's no guarantee that it's going to go back to the price that it was at before, and the price that it has to appreciate at in order to recover all of your losses is pretty substantial. But more often than not, a stock that falls 40%, probably falls another 40%, right? There's some major, terminal event, has happened, which has kind of changed change outcomes. And so, I think, obviously when I think of taking risk, the primary goal is, drawdown control and, significantly minimizing or curtailing drawdowns. And I think ultimately over time, that's how you compound capital, right? I mean, if the market's up 30%, and I'm up 20 or 25, I promise you I'm going to be pretty happy. If the market's down 30 and I'm down 30, I'm not going to be happy. If the market's down 30 and I'm down 5, I think that's a good outcome.
No, and that's a really important point, but it's also easier said than done in practice, right? So I always use that line: to kill it in the stock market, you have to not get killed. the attribution for the killing this year has been really around that kind of risk off dynamic breaking, which we'll talk about. But the drawdown management is critical, right? Because from portfolio management perspective, down capture matters more than up capture. That's what's a consistent theme in all my research papers. But having said that, in a year like this year, the question is, if you could have seen the drawdown coming, what was the best way to play it? You could have argued shorting, you could have argued cash. You and I both know that worked this year, but that's also really hard to do if you do any kind of rules-based approach historically, right, as a way of expressing a defensive posture. So let's talk about how you think about strategy development in an environment like this, where path is, for lack of a better way of saying it, all kinds of fucked. The way that everything is going to act. And talk about the importance of signals, because I do think that one of the dilemmas with FinTwit is that a lot of people will say things and they'll refer to a particular signal and say, oh, look how great it did in this most recent period, but there's no context around history there.
Yeah. Okay. So there's a lot to unpack there. I think first on sort of signals and indicators, I agree with you. I mean, to me, these are just tools in your toolkit, right? It's a framework to have probabilistic thinking. Now, even if you have a back test or a signal or whatever that's great and works 75% of the time, which by the way is great, there's always the chance that 25% of the time it doesn't work. That's just a fact. I mean, and unavoidable. Hopefully, a good set of indicators, signals, or whatever it might be, are used in such a way so that you, as an active participant in the markets, can make better judgment. That's kind of how I would think about it. I'm not going to criticize your product. I think the back test is sound, the thought process is sound. It all makes sense. What's happened is that we fell in that sort of 25% of the distribution, or maybe it's even smaller percentage of the distribution this time, and that's going to happen when you trade markets over the course of 50 something years. That's the reality of how markets operate. So I think it's absolutely critical to have signals and indicators, and the more history you have, the better. I think we've all learned that pretty well in the last 12 to 18 months, and that relying on all Fed cycles since 1990 and like stock markets go up, that's great, didn't prove to be very valuable, despite what people were talking about in the fourth quarter of last year. The reality is you needed to go further back and study more Fed cycles in order to have a better understanding of what was probable or possible as a result of the regime or set of conditions. That would be the other thing I would say, is that in my work, I try to think about what is the regime, what is the backdrop, and then I try to evaluate my signals and indicators in the context of that regime or in the context of that backdrop. So think about it as being, whatever, you have an indicator and you have 30 events. Is there anything you can learn if you cut those 30 events one more time between periods of Fed tightening and periods where the Fed's on hold or easing? And then is there a significant difference in outcome for your indicator in one regime versus another? And I think that can be very informative, and B, can help you to make better judgment in the present.
Yeah, no, I agree. But I think there's also this added element, which I think is really underappreciated, which is that it's not just about signal, but also the expression of the signal. So I keep making this point that if you were to look at the main signals that I'm known for, that these research studies I published, document, utilities outperforming the market as a signal of risk off, lumber to gold weakening as a signal of risk off. Those have actually been largely risk off. I mean, the frustrating thing is the interaction of the risk off expression as treasuries is what broke this year. Whereas, for example, if you used utilities, which is also a defensive sector, not just a signal, the strategy would have had much, much better performance. But historically, that's not usually the case. So when you think about the signals that you follow, let's talk about what signals do you tend to focus the most on, and then what are the ways that you express an investment view based on those signals? Because that opportunity set is really critical. So even though you may have a phenomenal signal, if you don't have a secular tailwind around the opportunity set favoring the signal really doesn't matter at that point.
Okay, yeah. So this sort of, this could open a bit of a Pandora's box. But what I'll say is, I think part of what you're alluding to is, in terms of execution, or is like, okay, well, how do you define risk on? Like, there's different types of risk on. There's cyclical growth risk on, which is kind of more in the realm of, like you said, utilities underperforming, or potentially EM outperforming. But then there's liquidity driven risk on, which is probably more of a NASDAQ led outperformance, right, rather than EM led outperformance, right? I think that there is a distinction between economic activity or cyclical growth driven risk on versus something that's more about, policy easing, liquidity, right? So I would make that delineation. And that's a little bit about what I alluded to about sort of different regimes and trying to identify what is quote unquote risk. Risk is a general term that we use to paraphrase your earlier point. Some people say it's volatility, but there's all different types of risk within the market, that can be categorized into growth, value, cyclical, defensive, EM, non-EM, right? All this. And so I think that's, unfortunately, to your point, I mean, I think that this is sort of where the execution of a signal or an indicator, I mean, I certainly appreciate the interest in kind of wrapping it up into a nice, neat rules-based ETF. And it like we said at the outset, it probably works 75, 80% of the time. But there are some regimes or some environments where it just requires good judgment on the part of an active manager to recognize that, okay, this part of the market is being driven by something else today. And irrespective of my signal, it's probably not going to work. Maybe it still works, but it doesn't work nearly as well as it did before, or in the worst case scenarios in the other direction, because it's driven by something else. Like when I think about rates and duration, what I would say is the more consistent signal, or I guess what has been consistent, has been flattening of the yield curve. So that's worked, right? And has been consistent with, I think, the environment that your signals would identify. But what has not worked is the level of rates, which was likely driven by a different factor that was not part of your back test, or not part of what the back test is focused on. Or if I look within the equity markets, like you said, utilities outperformance, broadly speaking, cyclicals outperforming defensives, low beta, low risk factors outperforming high beta, factors. So a lot of other things worked. I mean, the one outlier is like long duration. And then I think in that sense, we can say today, in some cases with hindsight, and maybe in some cases with what we sort of saw coming down, in the pipeline, at the turn of the year, that, Fed rate hikes and the volatility associated with Fed rate hikes and the speed of the Fed rate hike cycle, playing catch up to the environment have all, resulted in duration, proving to be a difficult instrument to use despite the environment supporting that, the environment vis-a-vis what we understood to be the historical backtest.
Yeah, and I don't fundamentally disagree with anything you're saying. I do think it is different when you're managing to prospectus than if you're a discretionary trader, where you can have this. And it's interesting, right? Because it's about the path, right? It's like, when you launch an ETF, it's a 4-month process. But more so than that, this question about judgment is interesting because you alluded to before, right? So you have any strategy, any signal, it's going to work, you said 75% of the time. I'd argue 50, 60 is a home run.
Yeah. No, I was being like very generous, even in the best of case scenario. Yeah.
Right, for sure. Exactly right. But my point is that but here's the thing when you're doing kind of, I think, rules-based strategy, which is that the moment that you subjectively make a judgment call on a particular signal or rule, it invalidates all the prior research, which doesn't have the judgment element. And I think, and it's kind of more an intellectual discussion, right? In the sense that if you want to overrule an approach, the problem is then you have to then decide when to go back to the approach again. Right. So you're introducing different variables. That's my argument, which is hard to also know from a subjective perspective, the timing of that.
No, okay. So that is definitely a fair criticism. But I guess what I was alluding to was what you're talking about is the implementation of a signal, not the merits of the signal. So I would change a little bit and say, like, okay, if you take your signal, what is it, lumber, gold, or whatever, and you said, okay, well, if instead, I could use duration as the instrument to trade, or you could use utilities versus industrials or whatever, some other pair trade.
Right, or you blend it with something else, right?
Yes, okay. So now if you were to take the outcome of your equity-based implementation, my guess is that the statistics are going to be very similar to, using duration. Is what I'm suggesting make sense to you?
Yes, and it would be a different. You're right. You get to the same place, but without the. I mean, the whole idea of the being all in treasuries historically is when it works, it really works in a big way. So your point is valid, right? In other words, if you created a basket of risk-off diversifiers, which could include gold, which could include the dollar, you'd still get to the same place, but it would not be as extreme.
Well, you would have less concentration.
Correct.
But you would still have a positive return. And then I think so then it becomes a trade-off of like, this is what I'm saying about the judgment and like being in, the importance of using, of having indicators and then using good judgment. I mean, either you learn early on in a signal that the instrument that you're using to implement your view is not working or is not behaving the way that it's supposed to. And that gives you the opportunity to pivot to then use an instrument that historically has been consistent, but maybe is working better. Right? So I just think that I'm talking more about the judgment associated with implementation as opposed to judgment associated with like ignoring the signal. And I think that's a little bit more of a product choice, and or maybe the return profile is a little less, but the risk adjusted returns are better or whatever. I mean, certainly easy to say that in the hindsight of the last 9 months, or to your point and comment is you have something that's a little bit more of a diversified basket of quote unquote risk off instruments. And that protects you against, I mean, maybe it doesn't completely eliminate what's happened this year, but it protects you against the severity of it.
Yeah, no, and that's a fair point. And I think also when you're a manufacturer of products, right? You have to kind of pick something and stick to it, right? So, but the point is valid, and it's not
Well, let me just use a quick example. So, for me, well, what I would say is okay, so you asked me about indicators. I'm cyclical time horizon is a big part of my framework. I tend to rely a lot on what's happening in the profit cycle, right? Like S&P 500 earnings growth and revisions, and naturally that also leads me to be pretty sensitive to what's happening in PMIs. And none of this is it's not going to win you any Nobel prizes in economics. I mean, these are all time-tested, storied indicators. I think it's much more about the other pieces that you put around it that help to strengthen your conviction in something. But I'll use the example of cyclicals versus defensives within the equity market, or similar to your utilities versus S&P or utilities versus the market performance. Historically, cyclicals versus defensives and various measures of interest rate or yields rising or duration are highly correlated. It's rare and there are very rare periods of time where you have cyclicals down or cyclicals underperforming defensives by as much as they have and yields higher. And it's an anomalous environment. I mean, it certainly has happened before. It just doesn't happen often. So from an implementation standpoint, what I would say is most parts of the market that I follow and see seem to be following along with the growth is slowing, cyclical growth is weaker, PMI is falling environment. So, and it's just that, rates and duration, which happen to be a big, important asset class, are moving in another direction for a reason that's not associated with those declines. And then there's also the weird thing that, kind of happens, fixed income markets and rates can be, more sensitive to stock versus flow. Right. So, unemployment rate is still low and the stock of the economy is still good and robust. It's the flow of the economy that is weakening. And then it's a question of does the flow of that economy weaken enough to change the opinion on stock, if that makes sense to you?
Yeah, no, I think that's exactly right. So let's talk about if maybe we're in a regime shift in the way that the opportunity sets interact with each other. And I shared in the Nest a tweet that got a decent amount of engagement yesterday around this idea that with the hot CPI data, long duration bond yields actually went round trip. They rose initially, they came back in. S&P had a nasty drop, but long duration treasuries on a relative basis held, and that's kind of more classic risk off spread behavior and high volatility. And I want to hear your thoughts from a macro perspective on what could be, I think, or at least I hope, a transition from inflation fear to fundamental fear, sort of the inflation volatility. Yeah. Right, to the fundamental volatility. Because if we go back to a more classic risk on, risk off dynamic, that only I think really happens if default premiums rise, which is what's consistent with higher volatility periods for the economy.
Yeah, so a couple months ago, I kind of floated the idea, or I wrote a note, titled, from Fed hikes to growth cuts, which I think allude to that. I think I wrote it in late May or something, and I have sympathy with that view, which is, by the time we got to May and into June, I mean, at that point, I don't think anybody was surprised by A, sort of inflation dynamics, and B, what the Fed's reaction function was to them. So I think a lot of that fear and concern and the process of getting, from where we were late last year to that point, kind of has happened in markets. It doesn't mean that it can't continue to be an issue like we saw yesterday, but I think like a big portion of that was part of what drove us down, from highs in January into, lows in, April, May, and June. I think that part of the reaction function to, a hot CPI print is like I think my interpretation is the market sees the Fed having to go more faster or more sooner. And as a result, the more that the Fed does today, the more hikes that they're, penciling in today, or the more that they're delivering, the tighter FCI is. And the tighter FCI is, the more likely it is that we have a, growth weakness in, in the future space, right? Like whether it's 3 months from now, 6 months from now, 9 months from now. And I think that that's pretty clear in the messaging from the yield curve. So that's where I see a lot of consistency. I think that like, when does it really, quote unquote, when does it really work? I think it really works when you start to get like, you get a negative NFP print, or you get some, for markets, kind of need that tangible data point that says the time is, it's on the doorstep.
Do you think that, and I kind of alluded to this yesterday, that the market was the reaction by the stock market wasn't because of inflation being high, but and not because of this idea that the Fed lost credibility, but because maybe the stock market is seeing the Fed having credibility, meaning that they see this elevated CPI, which is not coming down, and that they will act ultra aggressively. Because if you look at the Fed futures, now you got 100 basis points on the table.
Yeah, and you're alluding, you're saying that you think that like the stock market sees this as a good outcome. Is that the genesis of the question?
Or rather, that the stock market is seeing the Fed as now being ultra aggressive, which should bring stocks down. I guess that's sort of more the viewpoint.
Yeah, well, yeah, no, and I think that, like, listen, I'll give you a very, like, and maybe this is too simplistic, but I think it kind of makes the point. 6-month T-bills, right, cash, zero vol, incredibly liquid, offer about 4% annualized return. If you take the earnings yield on S&P 500 or some, kind of whatever your, global, equity index, let's say it's like, 5.5% earnings yield on forward EPS that I think most people agree is too high, consensus EPS. And I happen to think it's, has more risk than most, but like that's so cash now offers you a competitive return, and cash is now one of the few asset classes where expected returns are actually going up. I mean, that should be a big sucking sound from risky assets towards, quote unquote, I'll call it, you get paid while you wait. Right?
But by the way, real quick on that, because I think it's an interesting point, but you're not seeing it necessarily in savings account rates, right, at the bank.
No. But I mean, anybody can go buy T-bills. I mean, Treasury Direct. Right. Nobody's precluded from doing that. I mean, this whole different people have, but yes, I mean, the whole savings account thing is a separate issue. I mean, call your local bank and tell them that you want, the rate. That's a different debate. It doesn't mean that return's not available to you.
Yeah, no, it's a fair point. I guess I'm cynical. I think most people would probably just assume that their bank would pay them the higher rate instead of going directly to the Treasury, right? Because it's just easier, right?
Yeah. I mean, it's like I said, I mean, that's a question for your local bank, but I mean, I think if you went to your local bank and you wanted a 12-month CD or whatever, my guess is those rates are probably higher than, a traditional savings account, would be. And if people got thoughtful about it and they took their money from a traditional deposit savings account and they put it into a money market, then maybe the banks would change their, what they offer. Right.
Yeah, no, of course. You need to have that kind of pressure from the.
But my point is, like, from a standpoint of like we're capital market, practitioners, that still generates the return, even if in some part of the market they are offering a below average or below market rate. You can still take, and what I'm thinking about is more like the very big, large multi-asset, allocators of the world. Right now, if you have a choice between putting money in equities or various forms of credit versus, earning 4% in cash. I mean, 4% in cash is, looks reasonably attractive on a risk-adjusted basis until you feel like the clouds have.
Yeah, no, 100% of that. Okay, let's, and by the way, everybody here, please make sure you follow MrBlonde himself and check out his Substack, Stuck in the Middle. You'll see that on his Twitter profile. Okay, let's talk about some of the differences in reasons for why markets go down in terms of speed and duration, right? Because you had sent me a note saying that there's a difference between a risk-off correction, which is aggressive, versus a more prolonged period, which is more earnings-driven. Let's talk through that from a historical perspective. And which of those do you think is what we're facing?
Yeah, so I'm of the opinion that the correction that we've had to date, I'll say from January, probably into kind of the April timeframe, largely associate with markets correcting overvaluation and adjusting for what is has clearly become a fast Fed rate hike cycle. So entering 2022, my opinion was we basically were faced with peak liquidity, peak valuation, and peak earnings. And all of those kind of had to be resolved before markets became more attractive. I think that in the first kind of 5 months of the year, we made pretty good headway on adjusting peak liquidity and peak valuation. And again, very clear, it doesn't mean that they can't keep going. But if you said those were no longer big surprises to the market, and the market contemplated it and considered those issues. I think from the May to June period, I think we started to transition to quote unquote recession risk, or I don't really like to talk about recession. I mean, I think people talk about it in too binary of they treat it as a binary. Like if we have a recession, everything's bad. If we don't have a recession, everything's good. And the reality is somewhere in between. In addition, where the market is now digesting the consequence of that financial conditions tightening and rate hikes, plus what we've experienced in geopolitics and energy prices and the demand destruction that comes with the inflation that we've had. I think the process to adjust quote unquote peak earnings just happens slower. It just you don't get to a point where analysts, as in the bottoms up consensus analyst community is not going to take their numbers and say, okay, well, everything's going to be 25 or 30% lower or 10 to 20% lower. It's more kind of like around like death by paper cuts, right? They say like, oh, if it's a bad outcome, then things might be like 5% lower, and then like that just keeps getting stepped down quarter by quarter, stepped down both on the analysts as well as CEO. Show me the last company that went on the like the "We Suck" campaign and told everybody how bad their business was or how bad they thought their business was going to be. That just doesn't typically happen. I mean, kudos to the guy from Restoration Hardware back in April for actually talking about this and putting it out there. But I think earnings-driven declines happen over a few quarters, and that sort of is what drives a little bit more of a sell rallies, or what I've called like a one step forward, two steps back, kind of trading environment, because you realize that as time moves forward, that the base level or the fundamental level that you're operating with is actually now 3 to 5% lower than you thought it was, 3 or 5 months, 6 months ago.
It's interesting. You'd think that as Fed keeps hiking rates, fundamentals will matter more. In other words, you'd see more idiosyncratic dynamics play out across stocks, right? Because I remember I wrote a piece many years ago for Mark Faber of the Gloom, Boom, and Doom Report, and the title of it was something like "America, You Can Do Better." And the whole criticism was around how the entire narrative was purely, and obviously to some extent, is around what the Fed does as opposed to fundamentals, right? Which makes sense.
It should be.
It should be right, exactly, because
what I mean is, it should. I think your point is right. And this is sort of a little bit my point on what's offered from 6-month T-bills. Like said simply, like the hurdle rate is going up, meaning I can now get 4% risk-free from 6-month T-bills. So the types of companies that you're going to buy have to, will have to be able to deliver something better than that, and with a high degree of confidence. Because remember, your 6-month T-bill is a 0% guaranteed, 0% vol, guaranteed 4% rate. So I agree with you. I mean, I think that is what should happen, and that sort of is part of what I think results in the big sucking sound away from risky market towards treasuries, as they realize that a lot of companies maybe don't have there's not as many. There's a smaller subset of companies who have that idiosyncratic good positive attributes in the environment that we're in. So I think your thought process is right.
And I wonder how, if that partially explains something to me, which is a big disconnect, which is that the dollar's been abnormally strong. Everyone's worried about the Eurozone and a slowdown there, yet multinational large caps seemingly keep wanting to keep being the only place to be, as domestic small caps tend to keep on lagging. And I wonder if part of the dynamic is because there are a lot of these so-called zombie companies that are more in the smaller cap space, and as rates rise, the entire small cap segment of the marketplace has a harder time, and that harder time is more than the slowdown that comes from being multinational in a global slowdown, if that makes sense.
Yeah, I 100% agree. I think when you go down in cap, what you find is more leverage, and all else equal, like the access to capital is, it's not impaired. I mean, of course, they still have access to capital, but it usually comes at a different price. So if the cost of capital, let's use like triple B corporate, credit yields all in are at 5.25, that used to be 2. So when it was 2, even like these crappy, small cap companies that had a lot of leverage were able to, manage their business and, whatever. It wasn't hard for them. Well, it just got harder and more expensive for them in a whole bunch of different ways. Doesn't mean that the big multinational companies don't also have issues, but I think their ability to be flexible and withstand the punch is just, significantly greater. Margins are higher. Balance sheet leverage in general is lower. Free cash flow margin is higher. Right? They have more levers they can pull than the small cap company. So I 100% agree. I mean, I've made this point. We look at something like everybody, late last year wanted to, kind of crap on NASDAQ and said that, Russell is where you had to be because rates were going up and all the rest. I mean, those two have basically traded, back and forth with each other. But I mean, a big part of the problem for Russell, just generically talking about small caps, is, like I said, a lot more balance sheet leverage, lower margins, and substantially more cyclicality and earnings. So valuation is not just about PE multiple, I guess is my point.
Yeah, no, spot on. Let's get some of the audience up here.
Okay. Well, I'll start with the equities because that's probably closer to my domain expertise. I think everybody learned the hard way last year that Chinese equities are not a free and sort of open market for capitalists. I mean, and frankly, I think that this message was sort of delivered back in 2015 for anybody that cared to listen. If you remember, you had a difficult environment, and their response was like, "Oh, we'll just close the market." I think that's, in my opinion, that's a market you want to avoid, not a market you want to be putting more money into. And I think the message from they just turned their best well-run companies, the big cap tech sector, into state-owned enterprises through their common prosperity fund. And so now, as an equity owner, you've been subordinated further by the government, meaning the profits earned from Tencent, Alibaba, wherever, are going to fall to you as a shareholder. So to me, Chinese equities are a rental at best, and it maybe Ray has a different relationship with the regime, and when push comes to shove, they'll save him. My guess would be no. But so you have to be skeptical of any market where capital controls are on the table, and Chinese have made pretty clear that that's part of their toolkit. And I'm fairly confident in saying that they don't really give a crap what happens to outside investors in their market. I think that they're happy to let you in, and when something doesn't go right, they're not necessarily going to let you walk out. And that's notwithstanding whatever issues there are with the Chinese economy and their own profit growth and all the rest. But as shareholders, as equity holders, I think generally you want to be aligned with the company and company management. And I think that this is frankly one of the reasons that U.S. continues to outperform. Whether it's right or wrong, corporate CEOs in the U.S. are greedy and they want their stock price to go up. And you look at other parts of the world, that's not always the focus of the C-suite. But if you're in the business of trading stocks and making money from the stock market, I think that's an important attribute and one that needs to be considered. Look, I think gold, I don't know. I mean, there's times when it's right to be long gold, and there's times when it's right to be, short gold. I think that gold has shown that it's extremely sensitive to real rates, and the dollar's also sensitive to real rates. I think for all of the calls for the dollar's demise and the issues with twin deficits and MMT and all the other issues, I think that unfortunately, it's not like there's like some really good, better alternative. And gold hasn't, gold's maybe been a little bit of a better alternative, but it certainly hasn't been a lot better. It's certainly not for you as a dollar-based investor. I don't have a really strong opinion. I would say that, gold has probably proven to be the non-correlated asset that most of us thought it is, which means, when stuff is doing well, it goes down. When stuff is, not doing well, it maybe goes up, and there's a lot of noise in between. But it is, it's a zero correlated asset, so it kind of operates on its own.
And I would think that gold probably gets some momentum if you have an earnings-driven bear market where there's duration, right? Because I always make it a point that most things are a derivation of beta, right? And gold is unique, and you can argue kind of the ultimate diversifier because it really doesn't correlate to very much, except for moments in time, some high volatility in equities.
Yes.
But in order for allocators to position even a small portion of a portfolio into gold, they have to be convinced from a recency bias perspective that the beta bear market were to continue, in which case they want more non-correlation, which is where gold gets some momentum. But you need to have some time, I would argue, in an equity bear market for gold to really start to pick up.
Yeah, I think that's right. This goes back to the conversation we had, the earlier part of the conversation where we talk about like regimes that we're in and what the drivers are. The other thing I would say is that when you look historically at gold, I have a chart on my Twitter feed somewhere, I can repost it, but gold performs very well historically when it's above a rising 200-day moving average. And it performs very poorly when it's below a falling 200-day moving average. I mean, for what it is, it's a momentum asset, similar to the point that you made. And I think that when it's not in momentum, then you want to be, skeptical. It doesn't mean that, hey, maybe you're great at like picking spots and trading at a turning point. But as it pertains to like a core portfolio holding, it's generally better to trade it when it's doing, to own it and trade it when it's doing well and has momentum, and stay far away from it when it doesn't.
If you can help me a little bit on this point, just going back to emerging markets. So prior to 2012, emerging markets used to be considered a levered play on the S&P. Right? I mean, if the S&P was up 1%, you'd see EM, for example, up 2%. Right, so it's just sort of a magnified way of playing that. So once QE3 took place, in particular, the divergence started really taking place where U.S. started running away and everything else really lagged. Emerging markets went sideways for a decade, and the emerging market thesis, independent of the very valid point about governments confiscating companies, government state-owned and all that, there is an argument to be made still that emerging markets, at some point, at some price, are attractive, even from a longer-term investment perspective than viewpoint that you addressed. I'm just curious, what do you think? What do you think would cause emerging markets to get back to co-moving with the S&P? Because that's been one of those real structural breaks in the data, which I don't think too many people talk about.
Yeah. So okay. Well, I think there's probably a few things that happened around that period of time that you're alluding to that changed things too. I mean, I think it's true. If I understand how you're using the term co-movement correctly, they do continue to co-move. It's just that the beta is substantially changed, meaning they're still highly correlated, but persistently underperforms the beta that you were used to pre-2012.
Right, and you can argue part of that was the commodities super cycle ending and markets, and now even that broke, right, in terms of the historical relationship.
Yeah, so right, a lot of things in the composition of the EM market have changed, right, over that period of time. The other thing that happened is, remember, like from 2005 through 2013, I mean, the dollar was generally flat over that period. I mean, it was volatile, but it was flat. But starting in 2012, and then obviously had a really big move in 2014. The dollar started to be a more persistent uptrend. That's definitely been part of the headwind, and EMFX has definitely been the worst part of that. So I think one thing you could do is, if you look at like EM local versus EEM, which is effectively long EMFX plus long the stocks, EM local has probably been a little bit better at the margin. So the FX portion has been a big drag. The other thing that I've highlighted is, and this is a little bit of what I alluded to about corporate governance and being aligned with shareholders. I mean, U.S. markets have massively outperformed EM markets on an EPS perspective. So, nearly 100% of EM underperformance from 2012 is explained by earnings differential.
And how much of that is tech earnings? Because it's also a question of the composition of the sectors.
Yeah, sure. No, that's part of it. I mean, I guess what I would say is, if you show me an ETF or a market that lets me to trade, S&P X tech or EM X tech, then maybe there's a different story. But that's not, if we're just talking about broad markets, U.S. corporate generally produced more profits than, on a relative basis, than EM corporates. And also remember, through all this period, most EM companies are issuing shares, where most U.S. or developed market companies are buying back shares. So there's a lot of things that are going on over this period that have been, to the detriment of EM and to the benefit of US. And then, like the other big thing that happened in this period, I mean, the Chinese economy is slowing down. And that's, a big feeder for the rest of, VM. So yeah, I sure, at some point it would be terrible. You could never say never. But for me, I feel like EM is not something that I'm really interested in until I see some clear signs of that relative earnings momentum turning in favor of it. And so far, there has been scant signs of that. Like even when we have periods of like decent sort of robust cyclical, upturn in those environments, it's usually, US and EM earnings growth is more or less in line with each other. And then when we have weak periods, EM earnings growth is falling, is underperforming at a faster rate. So it just shows, more negative convexity than positive.
Right. And that goes back to full circle to the earlier point about signal and then how you're executing on the signal, right? So if you did, even if you just did a straight up momentum signal, or even moving average crossover on the S&P, the signal worked beautifully for the S&P, worked horribly for emerging markets. And I keep hoping emerging markets have a cycle that favors it, but that's been a headwind.
Yeah, no, I agree. I mean, this was one of the observations I had earlier this year because, for much of the last 10 years, banks outperformed when rates went up. And that stopped because of the nature of why rates were going up. And I would say that banks are, in my opinion, more sensitive to the cyclical growth cyclical growth activity, i.e. PMIs, than they are sensitive to the level of rates. So I think, and when you look, and this is, back to the earlier part of our conversation, that a lot of the internal equity market signals have been consistent with what we would expect from whether it's lumber to gold or ISM or other measures of cyclicality. They have all, stayed true to their performance. It's just that duration has moved in a different direction. So I have sympathy with your view. I think what banks are telling you is that, when credit spreads are higher and rates are higher, that's bad for banks. By the way, if you look at like Fed loan officer survey, it's telling you the same thing, right? They're pulling back. Their willingness to extend credit across a number of different categories has come off. I think that, obviously there's like the big bank things and, issue with buybacks is probably a little bit more a function of regulation than it is a discretionary decision, but it certainly doesn't help because one of the main arguments for being long banks was their ability to return capital to shareholder vis-a-vis, dividends and buybacks. And so that's been curtailed. So it doesn't help stock price. I think banks are probably a better credit investment than they are an equity investment, not to leave everybody kind of hanging. But like when I think about like the growth value debate that we have in markets, I think in many cases, you're better off being long your value exposure via the credit market and long your growth exposure via the equity market. And I say that because I think your value names, usually their terminal value is not the exciting part. And so they only really have to survive long enough for you to get paid on credit. Where in the equity market, the exciting part of equity is what you think or what people believe the terminal value of something might be. And that can keep an equity performing or going higher, even if in the short term, it's not super exciting or delivering quote unquote, profits. And so that's something I think a lot about. And so my guess would be, and I haven't looked at this, but my guess would be like bank credit has performed reasonably well and probably has outperformed bank equity over the last 9 months as a result.
Very good, everybody. Again, please make sure you follow MrBlonde. This was a great conversation. We'll have this as a podcast soon enough under Lead Lag Live. MrBlonde, any final thoughts as far as maybe being blonde?
Yeah, no, I'm actually not blonde, but I appreciate the time and the great questions. Hopefully it was insightful for everybody and gave a little bit more, kind of pulled the cover back on how I think about some of these things. And, I definitely invite you to, follow on the Twitter. It's at MrBlonde_macro. And for, kind of more in-depth thoughts and views behind the charts, you can find me on Substack at Stuck in the Middle. So encourage everybody to take a look and definitely send questions there.
Very good. Thank you, everybody, for joining.